Okay, so going over some charts for the S&P, Nasdaq, maybe the VIX. So right now you can see we have the S&P futures on the chart, no indicators, nothing. But what I want to do here first is just go to the moving averages and just take a look at where we are relative to some of the major moving averages like the 200-day moving average. So the past month or so, the markets have pulled back quite aggressively down to the 200-day moving average and actually overshot it a couple of times. Actually, one on this day, January 24th, and then it seems like it found some sort of short-term bottom. Okay, and it was able to manage a rip your face off rally after January 27th with a impulsive move that generated a move through the 6, 8, and then all the way up to the 21. Got pretty close to the 50-day moving average, which is typically where it should have gone to, but it failed to do that on the first rally. Pulled back, retesting the 200, and we're looking for a move up to the 50-day. Now that right there is going to be a pretty big resistance because, well, you can see that from past price action, it was acting like support 1, 2, 3 times, and then it broke through on the fourth attempt, pushing it all the way down to 200-day moving average, and then trying to make a rally back up above the 50, which is now acting like resistance. So I don't know if this is going to be a move that's going to take the S&P this week back above 4,609. But what I do know is that there's a 57 to 60% probability that over the weekend the futures could open greener, maybe red first and then green by Monday, opening bell, and then we could see a green candle forming somewhere here, making an attempt to break above the 4,600 level. Now, if it does that, then I think we're in a wave 3 setup. So if we pull up this Elliott wave, impulse wave, we've got the double, triple bottom here, which failed to break down even more. So we'll just assume that this is wave 1, this is wave 2, and then we're off to wave 3, making new 52-week highs. Now, how do we know how do we know with 100% certainty? Well, obviously there's no such thing as 100%. So we just have to manage risk, right? We don't want to go all in on a setup like this. And if we use a Fibonacci retracement, just to kind of see how much of a pullback that is, that looks like a 50% pullback. So that's relatively strong, okay? And it is something where you do want to get positioned long, not short. So there's probably in this situation right now, I would expect a lot of people, a lot of traders to be shorting this market, because technically when you have these rip your face off rallies, you do want to short the rallies, but it only works up to a point, and it might be ending until it might have ended already, okay, shorting the rallies, because it was a pretty nasty January. I think it was documented and noted in the reports that this is probably one of the worst Januaries ever. However, we're past January and into February, and it looks like the S&P is trying to make a break through that 4,600, and if it does that, then the best case for bulls would be a wave. I think this would be wave 1, 2, and then we get a 3, which would be a double top from the previous 52-week high in January. And then, as you know, the Elliott wave rule, wave 4 can't go through wave 1, and then we're up to wave 5 making probably a run up to 5,000. So that's the wave count that I'll be assuming for the year 2023. Now, I don't know if this is going to happen by the 5,000 mark is going to happen by the end of the year, by June, July. We don't know, but I'll just assume right now that we're in a wave, in a wave 2 that may have ended with this inside day candle, and then we're beginning a wave 3, which probably will be either exactly at 4,800 or a lower high, which will be around definitely under the 52-week high. And if that happens, then a wave 4 would be the next wave that would retest the wave 1 pivot, and if it breaks through that, then the whole entire wave is destroyed, and then we go back to the argument of this gap fill at 4,000. Okay, so that 4,000 is going to get filled sometime in the future. We just don't know when. Obviously, when the market was selling off, it came pretty close to filling that gap, just 214 points away from the gap fill. But obviously, you know, nothing goes down in a straight line. It's you get opportunities to go long and short, and both bulls and bears get fed in this market very well. But if you eat too much, you're gonna get your head ripped off, okay, off your body. So then this is what happens when you might have like shorted and you saw a whole bunch of profits come in here, and all of a sudden they disappeared and vanished, and then with that rally you may have shorted it more on that rally, thinking that this is another rally attempt, and only just to see your account go straight to zero. So we're in a wave 135 in the S&P, going to the Nasdaq. Nasdaq here, you can clearly see that the 200-day moving average was breached here on the 19th, overshot the 200-day moving average going into an extended position. So you get that overshoot again, looks exactly like the S&P, and then you get this wave 1 impulse wave. So I want to assume that this is wave 1, this is wave 2, and we're up to wave 3, but there's a 50-day moving average here at 15,650, which is going to act like strong resistance. And if it breaks through that somehow, then wave 3 will continue to move 1272 extension above wave 1, and then pull back when it hits these the 52-week high or double triple top here to retest wave 1. Okay, and if it breaks through wave 1, then the Elliott wave is eliminated. And then if it holds above wave 1, then we got wave 5 making new 52-week highs. So this is obviously a catching a falling knife. That would be the assumption. But with this candle on Friday inside day, I think it's clearly showing that wave 2 has ended and we're in the beginning of wave 3. So you want to be generally long the market in general. And if the market ever goes into the short position, we'll have to get ready for that. So the main point here is that we're assuming wave 3 for now. Okay, so wave 3, 1, 2, 3, and 4 is the retest. So it doesn't necessarily have to go all the way down to retest this level. It could be halfway here, or it could be all the way down here. Nobody knows. And then wave 5. This is the wave count that I'm assuming. And the other known unknown is we don't know if wave 3 is going to retest the top here. Okay, we don't know that. It could be it could make a breakout and make a new 52-week high, or it could just trade right underneath it, making a higher low. Sorry, a lower high. And then then the next candle after the lower high would start the wave 4, and then we don't know how far wave 4 is going to drop down to the top of wave 1, which was created right here at 4,594. But here, if we just honest with ourselves and not try to predict what happens in the future, because nobody can do that, and just focus on just the 2 candlesticks that happened last week, you can clearly see that the candlestick on Thursday was a pretty nasty candlestick. I think everything was like crashing and a lot of people were losing money. But then on Friday, it opened right inside the candle, and you can see that basically my portfolio in 750R has captured a lot of the big moves, and that created an inside day candle right underneath the 21. And if that is a reversal candle showing short-term reversal from the downtrend wave 2, then we will have to assume wave 3. Okay, so I'm assuming we're in wave 3 at the moment. And if we are, that's awesome, because you want to be long, and I am long. And let's see what this looks like on the daily Hikinashi candle formulation. So the daily Hikinashi candle is showing obviously a red candle, and that's a bit of a problem because we had that massive move right here. That's the ET, and that provided a great opportunity to take advantage of an ET, which we haven't seen in a while. And this is wave 2. Okay, so wave 1, wave 2, and if I'm correct, then the next Hikinashi candle, which will be Monday, will be generating a green Hikinashi candle, hopefully something like this, or it could be something like this. Let's just circle this one and see how big this was. So what I've just circled here is the subsequent candle formed from a previous day red Hikinashi candle, because the previous day, trading day, was Friday, and it's a red Hikinashi candle. So what I've done here is I circled the green candle, the subsequent Hikinashi candle that's green, that formed after, obviously subsequent after, formed after a red Hikinashi candle. So now if I change the candles from Hikinashi to normal candle, you'll see that you can see these big moves that formed right after it. So that's what we're assuming is going to happen on Sunday and Monday. As you know, futures opens on Sunday at 6 o'clock p.m. Eastern time, which is 3 o'clock p.m. Pacific time. And if futures opens up a little bit red, then that's fine. But if it starts dumping like 1%, 2%, then the whole wave 1, 2, 1, 3, 5 setup is not valid, right? So how do we know that it's not valid? Basically, just do that one more time. Go to Elliott wave. So we're not assuming that that's the bottom. We're assuming that this is the bottom, wave 1. That was the ET, and then it pulls back. So ET, obviously, the wave 2 obviously can go all the way down, make a double bottom at 4,255. But I don't think that's going to happen, because it's already did that a couple of weeks ago, where it made a low here, and then it just chopped quite aggressively for 1, 2, 3, 4, 5 days. So then we get this massive impulsive rally forming wave 2, and then you can see obviously this is an inside day candle. So that's the reversal. So then I will assume that that's wave 2, and then wave 3 conservatively, okay, would be assumed right here. when it breaks through the top of wave 1. Okay, so then if we go to the PowerPoint presentation, it's yeah, like right here. So rule so I guess the third wave breakout would be assumed right about here, if that's assuming wave 1. Okay, so but then we're getting in on Friday. We're assuming the wave 3 is on Friday, started on Friday, because we know statistically that holding positions over the weekend, you have a 57 to 60% probability of making money if you go long over the weekend. Okay, that's just the strategy that we use always in this Discord channel. We don't if it there 60% is not 100%, so there are times this analysis can be wrong. But when you are looking at interrogating the data set here is showing inside day candle, where we know statistically from past performance we generally make money on Mondays. So this is I think safe to assume that this is going to be a wave 3. Now if this is a wave 3, that means we're going to go into a massive rally for this week. Okay, for this week or next week, there's going to be a massive rally, and I'm getting my positions ready for this massive rally for the second week and the third week of February, because this is a wave 3. Okay, you have to understand that big money is made on wave 1 and big money is made on wave 3. This was probably a wave 3 on the downside. So if we look at this upside down, this was wave 1, this is wave 2, this is wave 3. Okay, and then I guess this would be wave 4, and then wave 4 did not push into wave 1, right? Well, it actually did right here. So this was choppy right here. Let me just redo that count. So the impulsive wave here is wave 1 from the top 52-week high, and then it did a wave 2, and then it did a wave 3. Okay, all this garbage here is just chop consolidation. Then this was wave 4. So we actually identified in the previous video that Apple was invalidated the wave 135 count on to the downside. You can actually watch that video. But now this is wave 4, and you can see wave 4 actually pushed into wave 1, right? So that's invalidates the wave 5 countdown to fill the gap at 4,000. So we're not in a wave 5 count anymore to the downside. We're actually forming something different. So wave 4 is here, and then it does look like this is going to be a wave 5, because you see the candle under candle, and then it's red, and it's moving. It looks like it's going to move lower like this. So if you want to be stubborn, then and then believe. I mean, if you take a look at the data set here, right, you can clearly see, like, just there's people in this world who spend lots of time and money trying to figure out this Elliott wave. And now I have a pretty good background in number crunching, and I know that you can't analyze every single wave structure. You just only want to care about what you want to care about, right? Just kind of like what you do with your hobbies. You just care about the things that you like, right? So I like wave 135. It's easy for me to understand, and I can adjust my position sizing accordingly and understand what type of wave structure I want to assume, because that's all you're really doing. Now here, and because I have material, okay, this was made back in 2010 or something, you can see the material here supports everything I say. So I'm not making, stuff up on the fly. This is exactly, here's wave what I'm showing here on the downside for the S&P, wave 1, 2, 3, 4. 4 actually pushed through the perforated black line to the downside. So if I go back to here, it pushed through wave 1. So that invalidates the wave 5 count, where we assumed that there's a good chance for this gap at 4,014 to be filled. That's a nasty gap, and I don't know exactly when that's going to get filled. Nobody knows. So we will just ignore that because we are in this wave 1. We're assuming wave 1, 2, and 3 is more likely to happen now, because we can see that the candlestick combo here, that's a bullish, and that's an inside day candle, and I would be on the side, that bullish side, because Friday going into Monday, that works with our TGIF cycles, and we all know that TGIF cycles produces a 57 to 60% probability of success to go long. So I even talked when I worked in the field a long time ago, and I worked with people who are just like some rednecks who are not they didn't know anything about the stocks, and they wanted to get themselves involved. All I told them was just buy on Friday and sell on Tuesday with the common shares, not with options. Options are a lot more risky, right? Because they can go to zero. It's like borderline gambling. But these guys were pretty young, and they wanted to make some money in the market. So I just tell them, just buy on Friday and sell on Tuesday. And you do that over and over again, you'll make some money. And yeah, and then I firmly believe you can do that, but you don't want to do that with all-in type of attitude. You still need to manage your risk, because 60% doesn't mean 100%. A lot of people think 60% means it's going to work out 100% of the time, which is not going to work. So the month of February, we have a massive rally that is setting up here, and that's going to push it all the way up to 4,800. Okay, probably. I don't know if it's going to go 52-week high, like 1 penny above it, or it's going to trade underneath it. You can see there's resistance formed here. Prices consolidated in the month of December right here at 4,700, 4,800 level. So, and then there's another cluster of price candles that form some sort of resistance level here. So if that's the case, then 1, 2, 3. So we're here now, and it looks like we're going to try to retest maybe wave 1. Okay, and if it breaks through that, then we gotta push to maybe retest this 4,741. And if we break through that, then we get a retest of here. So it's going to be a little bit complicated. And if we use, but from where we are right now, we close there. We have a 2% move, short term wise. So 2% going into a Monday and Tuesday, that's enough for a good TGIF, and that will generate some profits if you follow a strategy, buying on Friday, closing on Monday and Tuesday, and then we're out on Wednesday. So Wednesday is going to be tricky, right? Because is Wednesday going to continue the rally? And it might. Depends on the subsequent candle. If this is green, right, then we could get 1, 2, 3, 4, 5 green candles in a row, and that would be fantastic. That would be a massive rally that breaks right through all the way up to and retest that 52-week high. So that could happen this week. And if it doesn't happen this week, it'll happen next week. Okay, and if it doesn't happen in those 2 weeks, then the structure, we'll have to reevaluate the structure and then say, okay, this might actually, because you can clearly see we're in a downtrend. Oops. Right. everybody can draw a line like this, right? So we're clearly in a downtrend, and this is a huge, this is a very pivotal moment this Sunday and Monday. You can clearly see that we are in a downtrend. Now, TGIF triggers, and if we break out, then we're up. We break through this downtrend, and we're back in an uptrend, short-term uptrend, and then we can look to see more upside and possibly a 52-week high. Okay, and then a double top. If the double top forms again, then wave 1 will begin, possibly. Wave 2 is the pullback, and then we get a deeper wave 3, and then let's just say we get a double top sometime in February, and then we get an impulsive move down because of the Fed. So that will go all the way down to like here, right? We'll just kind of mimic, and then it bounces to wave 2, and then wave 3 down here, wave 4, another rip your face off rally, but maybe shallower, and then wave 5. And this gap is going to get filled. Okay, so it's not going to get filled tomorrow, but I could be wrong. We'll see how the futures opens, but we are in TGIF cycles. All right, so the positions I have in Tesla and Roku. So Roku actually has a really massive setup here. You know, everybody, I love Roku, even though I don't know what the hell this company does. I think the company is garbage, and everyone probably hates me for trading Roku so often, but it's the strategy that's simple, and for those who are working full-time, you might want to get your head around what a TGIF means. Okay, so it doesn't matter which company moves up on Friday, Monday, and Tuesday. We just want to make money, and they all move differently. So Shopify moved up 8%, Amazon on earnings, Tesla, whatever. So the only thing here that I see that is making me see dollar signs in my right now is the ASICs. Okay, so if you don't know anything about trading, then all you really need to focus on are these dots right here, using the TTM squeeze. And you can see whenever there's a TTM squeeze that develops, there tends to be a big move that happens after. So whether it goes higher or lower, that is going to be up to the trader to decide. Now we're getting another A6 in Roku. So what this means is that there's going to be a huge move coming in Roku, like a massive move. Okay, and I have to, and I've been trading Roku intermittently along this downtrend, and it worked sometimes and it didn't work. Okay, but if we think in terms of statistics and past performance, you can see that Roku has dropped more than 74% from its 52-week high. All right, so this is a golden opportunity to make some really good money on Roku. Okay, and you're going to have to decide how you're going to position size at these lows. If you want to go aggressive, or TGIF strategy that I've gone through exhaustively to try to help people understand, their tolerance and risk. Using a $10,000 account, I suggest using the maximum size of 15%. Now, when you are following this and you're trading TGIF, you should have, like I'm up in my TGIF position and I have about $4,000 in profits. I have a position that's half position in Roku in the 175 calls. I closed out the 170 calls last week. And I have 10 contracts left in the 170. It's fives. Now, if so, I'm gonna have to hold on to those and then manage them on Monday and Tuesday, and get ready for the next TGIF, and also get ready to know what to do on Wednesday. Because if Roku decides to rip hard off that A6, I'm 100% assuming that this is going to be a rip to the upside, because the downside is already exhausted to death. Like, look how many people, I don't know, you probably, if you have any friends trading Roku or buying Roku common shares for their retirement, right? They bought Roku back here in 2020, and they were making a lot of money, but they never sold. And now they're down here back at break even, right? Or maybe losing money. This is, this is an opportunity. Okay. So I think the downside is limited, and we have lots of upside all the way back up to 4014. So when you take a look at this chart from 2020 to 2022, 2 years ago, the price was not too bad. And then 1 year after, it was like how many percent up? Like 400% up, 250%. And then it dropped 74% of that from its 52-week high. This is an opportunity. So the downside, how many people do you think lost money? Like a lot of people lost money and not probably feeling very well. But eventually, 2 years later, it could be making new 52-week highs, and they're going to be back, happy again. So this is the downside is exhausted, in my opinion. 74%. Like I said, it was probably exhausted back here. I should have known about this garbage, this Google garbage here, where they gapped it up on the new contract agreement. But I thought the downside was limited here, but then it was wrong, and obviously it went even lower. And then I think with the news of the Fed introducing a couple of rate hikes this year, that has now fully been priced in, because there was a reason for this Roku to be dumping the way it was, and I guess it's just because of the interest rates. So people already knew this in advance, not me. Okay, I did not know that Roku was going to go from 400, 500 all the way down to 150. But after, with position sizing, you could survive a couple of TGIFs along here and still be able to get ready for this massive opportunity here that I think is going to explode Roku up to $200 possibly this week, probably. Okay, now let's go into this a little. So we have a wolf wave, which is one of the most powerful indicators that we have, and it's been obviously working most of the time, I would say, but it's a legit indicator, since that it gives you decent entry and a decent target. And with this A6, if you take a look at how we look at wolf waves, we have a lot of redundant patterns forming. We have an A6 that's redundant both on the 21 length and the 14. We have the wolf wave that triggered back here, which is indicating a pretty big move. And we all know that a pretty big move up to 213. We've got earnings run. This is a recipe for a big, massive rally. And then on top of that, we have more than $1.2 million worth of Roku shares in the 750R. If you don't know what 750R is, 750R is for people who are serious about retiring in the next 5 years with $500,000 to $1 million, depending on their initial principal. Okay, so this is huge. I mean, I can't stress enough how big this opportunity is. And with this wolf wave, all we need are these Bollinger Bands to be contracting to the point where it makes this massive move to the upside, expands, right? So let's take a look at this, the Roku position. And here's the 50-day moving average at 198. It's kind of, it's on an obvious downtrend, and now it's kind of found a little bit of a rounding bottom. And if we got that A6 here on the daily, and then I don't know what it looks like on the 70-minute, probably nothing here. But I think there was some sort of BLT set up on the 3-day. Okay, kind of like a BLT. Let's see on the weekly. Weekly candle over candle. So 190 maybe gets above the 170 level here, or 192. Daily wise, we're looking at the half of the 50, which is 180, which is going to make our contracts. If you have the 170, it's going to be worth $10 per contract. That's going to be a pretty nice win. So that's the A6 here, and that's a no joke with an earnings on the 17th. So this is looking for a pretty big move short term that we are positioned in. Okay, so then moving on to Tesla. Oh, just one second. Going back to Roku. So Roku on the daily, if I make a new chart here on Roku and then take a look at the Hikinashi candle, right? See, it's exactly the same candlestick pattern that we have for the S&P and the Nasdaq, right? So if we go look at the Nasdaq here, or Nasdaq, you can see that the Nasdaq has these two red Hikinashi candles. This is going to confuse people and think that the momentum is still to the downside, which, I mean, yeah, why not? Okay, so the little wick here on the top shows that the downtrend is a little bit probably limited here. You want a flat top. Flat tops on these Hikinashi candles show you the relative strength of the sell-off. So this sell-off right here in the past 2 days, it's got this little wick here, which is not good for the bears. And then we look at the S&P futures, you can see that the wicks are getting a lot bigger here on both ends. So I think the downtrend is kind of stopped. Then when we look at Roku, you know, it's got the similar two red Hikinashi candles, and whatever happens on the subsequent candle, it could be pretty explosive. So you can see right here what happened was, let's highlight that. We had the 10% move on Roku on Friday, and let's see what these look like. So that's after a red candle, right? So there's a lot. Let's just look at those two. So that was 1, 2. So if this was Monday, that would be Tuesday, and that was a massive move. I don't think we're going to get a 22% move. That was like 22% move. And then this one right here, which is kind of similar to what we have. We got red, Hikinashi, green, and then another green, right? Red, Hikinashi, green, and another green. That was, how big of a move was that? From here to here. That's a 10% move. Yeah, I don't know. It could be another 10% move. Another good thing about this Roku is that they could price in the earnings beat from now into February 17th, right? It could just keep on running all the way into earnings, and then once they release earnings, you know, nothing happens because they priced it in before. So that's why you want to get into those these earnings runs, because there's always another chance for it to just run. And then if you look at Amazon, what happened, it did the opposite. It dumped so hard into earnings. Like, that was a pretty crazy dump off of a bear flag, if you assume that was a bear flag. Dark cloud. BLT'd, right? Actually opened way up here, and then it gapped all the way down here on earnings, and then it just, you know, this is a pretty hardcore looking gap setup. So I don't know exactly how I'm going to trade this if I were to trade it. But yeah, Roku's set up for a pretty decent run, I think Monday and Tuesday. So confirmation is basically watching the futures at 4 a.m. Monday to see if it's green. And then that's going to be a pretty big green sign for us that Roku's going to break out. Going to Tesla here. Tesla has this gap that's not filled. but we cannot. It did this little magic mic here on Friday, and it's a bit tough to assume that this is going to get filled on Monday and Tuesday because that's our TGIF strategy. We don't try to go short on those days. And if we take a look on the Hikinashi candle, we actually have a green Hikinashi candle forming that formed last week. So when we pull up the, oh my God, so there's there's a A6 that's also forming in Tesla, but that's when we turn on the Hikinashi formulation. The Hikinashi formulation is a little bit different because it is based on the centroid position, and that will change the way that the TTM squeeze will calculate its squeeze. If we turn off the Hikinashi candle, you can see there's no A6. So this is a little bit tricky. I think that A6 on the Hikinashi candle, they do work. And I do have the 1050 calls looking for a move on the TGF up to 978 by Monday or Tuesday, and then I close them off. Okay, and I don't know if this is going to squeeze on the Hikinashi formulation, but you can see when it does squeeze, it does make a move. So that looks like a purple D setup with so it's redundant because you got A6 with purple D here, and then a 50-day moving average at 980 with a UTL at 1042. So this could pop on whatever news induced. I think basically whenever I look at this TTM squeeze and I see these dots form, it means that there's some sort of news or price action that's going to make a pretty big move. And it looks like Tesla took a pretty big beating the past since its run up here. I think it's dropped like 33%. And yeah, believe it or not, there's actually people who hold through a 33% drawdown, which I don't think is I don't think anyone should really do that. Like if you have people, there's a lot of YouTube gurus who put all their net worth in Tesla. And I don't know if I agree with that, but what can they do when they don't know how to manage risk? Or, first of all, they're not managing risk, because I think I stopped watching these guys, but I can just I've already collected enough information off them. They're obviously making more money on their YouTube content, which is great, but that's a lot of time that, they have to sacrifice in making those videos. And when you keep on watching them, it's just the same garbage being vomited 3 times a day. I don't know how much you can listen to that stuff, but some of them are actually all in. And let's say you had $1 million. Let's say you put $500,000 in Tesla here, and now you're at $1 million, and then it draws down. You lose 200,000. You get your 200,000 back, and then you're down like 400,000, and then it goes up to you make your 400,000 back, and you're down 400,000. That opportunity cost of losing 400, going through a $250,000 to $200,000 swing, that's really unacceptable, right? You can't just you can't do that. It's basically it's basically blatant. If you have $1 invested in Tesla, and your dollar is swinging up and down by 50%, it doesn't really make a difference, right? Because you're not a serious investor, or you don't even know it doesn't harm you. But when you start making more money, and your account grows to the point of to where it's it grew a lot, and now it's now in the millions. The opportunity cost of those swings, there's no joke. You need to optimize and create some sort of system that mitigates those traumatic drawdowns. They can't, making $300,000 disappear in 1 hour or 2-3 days is no joke. having your $1 go to $1 to 50 cents, that doesn't affect anyone. But once you get to a point of, in economics, we call it economies of scale. When you get to the scaling point where your account grew to $1 million, you cannot afford to go through these drawdowns, no matter who you are or what you do. You just can't. Okay, unless you have a plan. If you have a plan and you think that Tesla is going to go up to, $2,000 to 5,000, then you better be averaging down. You better take your money that you're going to buy your significant other with those Valentine's gift and tell her you're not going to buy any more gifts. You're going to buy Tesla, because that's what you should be doing. You should be buying the dip on Tesla if you assume that Tesla is going to go up to 5,000, 2,500 this year, next year. Okay? But if you're not doing anything and you're just bending over and spreading your legs wide, watching your account go from 1 million to 600,000, then that's like, honestly, I don't think I can be friends with people like that, right? Because look what happened with the hodler on the Dogecoin. He went up from I saw this video where he's going into YouTube. Obviously he's going to go into YouTube because the people who are making YouTube videos convinced him that you have some sort of influence and you can make more money doing YouTube videos than trading Dogecoin. But his Dogecoin net worth went from whatever it was, 180,000 to 3 million on the day of SNL, and then it dropped all the way down from 3 million to 500,000. That's reckless, right? And the funny thing is, the people who interviewed him asked him if he regrets not closing anything at the high, and obviously his answer is no, he doesn't regret, right? But deep down inside, numerically, of course he regrets it. He just can't say it, because if he wasn't able to close at a 52-week high at $3 million, you're not going to say, you're going to continue to just say the same things over and over again, but realistically underneath, you're in trauma, right? You're up at $3 million and now your account is at 500,000. And what kind of answer do you think you're going to say? Are you going to say you regret it? You're probably not going to say anything to that line. You're probably going to say that you're either going to say it's still going to go up to, Dogecoin is still going to go up to like $1 to $5, or you're going to say something. You have a couple of different answers. You're going to respond back to that type of question. And you have a higher probability of not saying that you regret it. There's a better chance that the person who's gone through a massive $1.2 million drawdown, you got a higher probability that somebody's going to say something like, it's still going to go higher, or as long as I have my initial investment, everything is profit, whatever it may be, right? Because you got 5 answers, and one of them is like, yeah, I regret it. So if you have 5 different types of answers, that answer where you say you regret it has a very low probability, right? 20%. So yeah, this is, nobody knows where Tesla's going, and yeah, long-term wise, it does look like there's going to be a breakout sometime in March. And actually, if we go ahead and take a look at the TGIF setup here in Tesla, so you can see here it triggered last week, and yeah, the week before that it also triggered, and we did make a little bit of money. 10 seconds into the close would have made us a lot more. But last week it did well. So I'm assuming that this purple D on Tesla is going to probably try to break out above 337 and then probably retest this Darvis channel here at 988 or 960. Okay, that's what I'm looking for. There's a bunch of price clusters here that is maybe suggesting resistance. Here, there's price clusters here, and in the middle of that cluster as a moment. So whatever happens on Monday, it's either going to break out above 937 and make a run to one of these previous Darvas channel highs here at, what is this? 951 to 963 to 985. Taking a look at the performance record here on Tesla, TGIF on Tesla just seems like it just rocks, right? Just keeps on going higher and higher, crazy. So it's got a 55% win rate, 2.02 decimal odds. That's massive, right? And that's on common shares. And the largest winner could be around 8 to 16%, assuming a 2 standard deviation from that, because this is when they close the position. The largest winner could have moved another 8% higher, and then at the end of the day, close that 8% profit, right? And looking at the trade list here, yeah, you can clearly see that the last last one here, the last winner was an 8.55% move. You can see there's also 19% moves as well. Okay, so that looks pretty good for Tesla. Tesla might do another green dot, pushing it up even higher, and the system is long Tesla, so momentum is there. Now looking at Roku, like I said, Roku is going to be one of the biggest moves ever, and I think it is pivoted off of that low. And we did make, if you followed the TGIF trades with me, okay, we did make money on Roku the past 2 weeks, and it kind of looks like the TGIF like pivoted here. I don't know which day that was. That was trade number 25, right? So if we look at 25, that's January 13th, and we go right here and select that point. That says, what day is that? January 4th. So 25 is January 10th. So that is the pivot, right? We're around there. So when you take a look at your equity curve, you can see that we're doing a little bit better because we're obviously trading options. This is trading common shares. But what I'm saying here is, if I take this screenshot, and I don't know if anybody ever remembers what I say half the time, but real equity traders that are trading in the market with hundreds of millions of dollars, you don't use you don't use the charts like this. You don't do this, okay? People who have a 750R account have to look actually at the performance report and then do your drawing your line garbage on that chart. Okay, so if we go here, then I want to take this performance chart and start drawing on it, right? So I say, okay, this is a massive trend and it broke, right? And at the same time, it's a bull flag. Okay, and it's breaking out of the downtrend. You could do it like that. Or you can do another type of analysis where you just say, okay, that's the bottom, and this is the top, and we're range bound. So we're in consolidation, and the price of Roku, because it bounced off of support, is going to break out, either going to go to the double top there and then pull back, or keep on moving higher, making another run up like it did last time it did one of these things, right? I mean, I'm giving everybody the secrets of how to trade this market, and this is the bottom here. Like if that's the bottom, right? And if you think about it, each one of these green dots represents an equity high. The beauty of TGIF is that it never assumes to go short. So you already removed that nagging wife that keeps on telling you to throw out the garbage or to do the dishes, right? You don't have to listen to that anymore because you're not ever going to buy puts. Okay? The strategy is always long. Now, if that's the case and you see that the performance is trending, then you stick with the trend. And once it starts moving and it's and the trend is making sense, then you form your first green dot right there. Once you form your first green dot, it's like going to the casino and betting on red on the roulette table. Okay? But what's the probability of betting on getting that second red? Okay, it's still less than 50% because each event that is being spun, that ball is being spun on that roulette table, it's independent of what you are going to, what you got from the last, whatever color came up from the last spin, right? So intuitively, you want to bet on the red. Again, do you know why? Because the probability is lower, and you want to bet on the lowest probability of success when you go to the casino. Casinos make money on people who are most of their money because they have an edge, and you do not want to. There's no edge in the casino. You have to always I think most of the time you've got to bet with setups that look like they're not going to win the next spin and over again. Okay, so you just don't want to bet on something that looks like 100%. If there's a casino game that's saying there's a 100% probability of winning, you want to actually put your money on the opposite side. Okay, so that's casino. In the casinos, the house always has the advantage. They're going to have a 1 to 2% advantage over the gambler long term. Now, in the market, it's not like that. The market is fair, okay, most of the time, especially when you kind of do some research and find some strategies. So this strategy is 60%. So if you win on the first trade off of a strategy trigger, you get this green dot, especially when it makes more profit from the previous green dot. So then the next green dot is what you want to assume is going to happen again. And then you can see that you can get consecutive wins over and over again as long as you manage your risk, because one of those trades it could go against you. So when we fast forward to now, you can see that there's no green dot, right? We're far from a green dot. It has to get up to here. The last green dot was here, right? That's the last green dot. And there's no green dot here, right? So that means there's upside. There's a lot of upside in the strategy, okay? Now, once it gets to here, that's going to be tough to say. Is it going to break out or is it going to break down? But what I'm trying to say here is that you have a 60% probability of success. Think of your TGIF strategy as a color on a roulette table, black or red, and then you picked red for black. Okay, let's just pick black. So you won on the first black, okay, which is what we're in right now, TGIF. Okay, and then all you got to do is just manage your risk. So when it goes up more on Monday and Tuesday, it's going to form a green dot when it closes on Tuesday at 10:30 a.m. because that's how the strategy works. Okay, and then you come back next Friday and do it again. And then you're going to get another green dot up here. Okay, there's going to be probably another green dot like up here. And then you do it again. And you get another green dot up here. And what it's going to end up looking like is going to end up looking like a big black line that goes straight up. And then, of course, it's going to not go straight up like that. It's going to do these things up and down like it did here. Okay, so basically you just take this. You basically take this chart right here, copy paste, and then supersede it right to here, and that's what it looks like. Do you understand what I'm saying? It's called a strategy. So you got to you're at the roulette table, and you put on $100 on black, you win. So the chances of getting another black is very low. So you got to bet it again, because casinos make money on people who think that red is going to come next, because the 50-50 thing is you can get 10 blacks in a row, right? And in the long term, you'll get a whole bunch of red in a row, and they'll even out to 50, 49, 51%, right, in favor for the house. So let's just say we're black, and we bought black, and we win. So the next one is going to be, so the next TGIF, when it triggers, it's going to trigger another TGIF, and we do it again, and again, and again, and again. And this is what Roku is going to look like, in the next run up. And this is a beautiful, beautiful image, because not only am I recording this, I'm going to bring this video up again, and you're going to see that this is actually going to play out again. Okay, this is a great opportunity to make a lot of money in Roku on a very simple strategy. And trust me, I don't care about Roku. I don't care about any of the stocks. There's no way anyone can trade 2,000 companies with an account of like 100,000 to 200,000. Not even $1 million is going to get you positioned into all 2,000 companies listed in the exchange. There's no way to do that. So first of all, you accept the fact that you can't trade every single ticker. If Snap goes up 50%, it's like, oh wow, like how am I supposed to do it after it dropped like 60%? How am I supposed to know that? You can't. So you stick with what you know, you stick with the strategy, and you manage risk. Okay. I don't really care about Roku. I don't care about Tesla. I don't care about anything. All I care about is where I'm going to be from now till 3 to 4 or 5 years later, and I want to be retired by then, because I can't imagine every day I'm thinking, how the hell am I supposed to get out of this stock trading and enjoy the rest of my life drinking pina coladas on the beaches of Koh Samui. Okay, and I'm actually, short-term wise, I'm actually really, really trying to focus to the point where we can go and have a meetup in Vegas. Like I said, that's something that I've always created a goal on, and I did attempt a couple of times to make some meetups in the past in Vegas, but it failed. And through failure, right, you have to figure out what went wrong and how to improve it, and do it again and again and again until you reach your goals. Okay. All right. So that's pretty much it. I only have 2 positions going over the weekend. Obviously, I do not know what's going to happen tomorrow when the markets open up in about 4 hours from now. So, obviously, if you do have an account membership with me, then you want to be paying attention to the futures here. Okay, so the futures, either it opens up green or red. And if it opens up green, because it looks like it dumped in the last 30 minutes, 90 minutes of the day on Friday. So that's dumped right to the UTL. There's actually a 78-minute TTM squeeze on the Nasdaq and the S&P. So if we are in a wave 3 to the upside, there's about a 2% move that we're expecting either on Monday or Monday and Tuesday. And that's great setup for our Rokus and Teslas. This is going to make a nice move up to 170, maybe even 180 if you hold all the way to Friday. Whatever I do with those 175 calls, I'll just close off maybe half and then let the rest ride into Friday. All right, thank you very much. Enjoy the rest of your day.